Hi, I'm Steve Kalan with NACD, and on today's BoardVision, we'll be speaking with Keith Wallace. Keith is a partner and international assurance practice leader for McGladrey. He works with McGladrey leadership and its international engagement teams and clients to continually enhance global service capabilities and help their clients with their global business and accounting challenges. Keith, it's nice to have you with us today.
Steve, it's my pleasure to be with you today.
We all know in business that cash is king. This would appear to never have been more accurate than now, as many companies begin to emerge from the global financial crisis. We've identified a growing number of global companies that reflect a sizable amount of cash on their balance sheets that may not have the level of liquidity that one would expect. What are the factors that executive management and their directors should understand related to the global cash reported on the balance sheet?
In general, Steve, I would say there are two main areas of understanding that management and a company's directors should have about the entity's global cash. First, where is it located? A couple of reasons this is important deals with the ease and ability to transfer the funds back to the U.S., and the second is related to the currency risk associated with that local jurisdiction. Secondly, you have the financial implications of the repatriation. In that, you have the reduction of the cash that's actually available for payment following the tax withholdings, as well as the earnings impact that a company has after it decides to repatriate the funds.
Keith, what can we tell our directors about the tax consequences that many companies face when repatriating their cash back to the States?
This is a highly complex evaluation that is very different on a company-by-company basis, as I'm sure you're aware. But here there are three general observations that I would point out. First, in many jurisdictions, the company will be required to remit taxes to the local jurisdiction related to the earnings being repatriated. Second, in some cases, the company may be able to utilize credits for amounts being paid in the other jurisdictions. And third, overall, in many cases, companies will see a sizable reduction in the amount of cash available at the end of the transfers.
Keith, these are highly complex evaluations regarding the repatriation of cash back to the States. So let's discuss the effects on strategy from a director's perspective of risk oversight. What are the top areas of concern that fall within the director's responsibilities?
I agree. These are some highly complex evaluations that are clearly management's responsibility. However, given the pervasive impact a company's overall liquidity has on strategic decisions, I would highlight the following three areas for the directors to place focus when considering a company's global cash and liquidity. First, strategic decisions. Directors are constantly evaluating and approving decisions related to a number of areas impacting a company's cash balances and liquidity, including debt refinancing, mergers and acquisitions, including their source of funding, and declarations of dividends. Second, risk management. A company's overall liquidity is clearly a component of the entity's enterprise risk management, whether it's through a formal or informal program. And third, yes, financial reporting, something very near and dear to my heart, Steve. Review and approval of the company's annual and quarterly financial reporting is clearly a part of the director's responsibility. Beyond the obvious implications on the company's consolidated financial statements, the liquidity evaluations clearly impact the company's MD&A discussions and disclosures. Just as a side note for the directors, the U.S. SEC has added a significant amount of focus on the liquidity disclosures in the upcoming 10-Ks. So this is an area of focus that the regulators have and that you should add to your list of areas of focus.
Keith, thanks a lot for your insight and comments into the global cash and liquidity challenges that multinational companies face. Basically, we've learned the importance of understanding the location of a company's cash and the potential impact on both the cash balance available following repatriation and the related exposures for additional income statement charges, which is something all our directors should take away from this. It's been a pleasure speaking with you today. For Keith Wallace and McGladrey, I'm Steve Kalan, and this is BoardVision.